Let's talk money.
Hello and welcome to this latest edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. The budget has brought in tax relief for certain categories of hybrid funds. Some of these funds were earlier being taxed at the investor's own slab rate, which of course could be as high as 30%. But now the long-term capital gains tax on these funds has been slashed to just about 12.5%. So there is a huge tax advantage. Is it worth, therefore, considering these funds for investment, given that not just tax, but there is market volatility and there is a need to diversify risk across asset classes? Welcome to part 2 of our capital gains tax classroom. Last week it was all about property. This week we are going to talk about hybrid funds and where they should be when it comes to your portfolio. Joining me to discuss this today are Mohit, CEO of Moneyfront, and we also have Devendra Singhal, Executive VP and Fund Manager at Kotak AMC, who manages Kotak's multi-asset funds. This is also a category which actually gets that tax advantage. So gentlemen, thank you so much for joining in. Good to have both of you on. Yeah, there we go. We are seeing Devendra also, who's joining in remotely. So let's get the first thoughts in, Mohit. So this is the mutual fund tax classroom now. Your first thoughts on this change of 12.5%, which is coming in for a large variety of funds, right? Which were in that in between. They were neither pure equity nor pure debt, but the in between ones.
Surabhi, I think first and foremost, I think mutual fund investors can't complain about the change of taxation in this budget. Honestly, I think yes, long term and short term has gone up a little on the equity side. That hurts to a certain category of investors. But for investors who were investing in international funds, who were investing in balanced hybrids, conservative hybrids, who were investing in multi-asset funds, who were investing in gold funds and fund of funds and all those categories, they gain a lot. Honestly, they benefit a lot because of this whole change of taxation. And now there are only two classes of or two holding periods, which is 24 months and 12 months. So the budget has done away with the 36-month holding period per se. The budget has done away with the indexation thing. But what the budget has done brilliantly is made the tax rates uniform, right? So there is extreme amount of clarity and simplicity now. All these categories now get classified as long-term after 2 years and get taxed at 12.5. So
yeah, that's actually a huge relief. At least, you know, long-term now is 2 years. That whole concept of first, whether it's 36 months or whether it is 24 months, at least that gets taken away. Let me bring in Devendra as well for some opening thoughts, and then we'll go category by category. Devendra, what is your first take? The fact that there were some funds which were being penalized really severely, right? Because they were being taxed at the slab rate. Now that tax rate comes down to 12.5%. So what is the initial feedback you're getting from investors?
Hi, Surabhi. So as Mohit rightly pointed out that, investors in general have nothing to complain about, especially the mutual fund investors. And, the hybrid fund investors are, I think, on a sweet note here, because now it reduces the, complexity. It simplifies the tax structure. It reduces the holding period, which is a big advantage for the investors, It brings a lot of agility to what they can do with their money, rather than waiting for it to get long term and then get slightly better in terms of taxation. Now that hold period is also went down to 24 months versus 36 months, which was earlier. So specifically in the categories of conservative hybrids and fund of funds, I think it's a brilliant move.
Okay, and we're going to talk about all of these specific categories in more detail. But to begin with, investors, I think there's one thing that we all need to ask ourselves when we're talking about hybrid funds. And as the name suggests, a hybrid could be a mix of debt and equity. In some cases, if it's multi-asset, it could involve gold or silver or other asset classes as well. So the first thing that investors, we need to ask ourselves is whether this hybrid fund has 20% equity, 30%, 35%, 50, 65%, because the taxation depends on the range of equity and debt that fund is holding. So as investors, that's the first point of awareness, to ask whoever is advising us on that fund in terms of what is the equity contribution. So with that caveat in place, Mohit, let's get started. And I want to start with the simpler things first up. Funds where the equity allocation is at least 65% or more. Here, nothing changes, right? It's just that the 10% tax now becomes 12.5% tax.
And 15 has gone to 20 on the short-term side. And the long-term capital gains exemption limit has got increased from 1 lakh to 1.25 on the equity. So these are the three changes. But per se, fairly simple for investors to understand.
Okay, but it's important to know what all funds fall under this category. I mean, at least in terms of nomenclature. So pure equity funds, which are going up to 100% equity, we all know,
Yeah.
equity mutual funds. Here, which are the subcategories? For instance, arbitrage funds
Absolutely.
always had a great equity taxation
Yes.
advantage. Does that continue?
Absolutely, absolutely. So arbitrage continues to benefit with equity taxation. The whole proposition of arbitrage was that it has equity composition or hedged equity composition over 65%. So that continues to benefit. Even equity savings as a category, Surabhi, where naked equity plus hedged equity, as in the ARB component combined put together was over 65%, and that continues to benefit from the equity taxation per se. So any form of equity where the Indian equity composition is greater than 65% will continue to get taxed on the equity parameter.
Okay, so that includes arbitrage funds. It will include, like you said, the equity savings fund category.
Equity savings,
as well.
arbitrage, and also some kind of balanced funds where the equity composition is greater than 65%. But as you rightly said, balanced category has to be seen scheme by scheme, fund by fund, where you have to actually figure out the equity composition. But yeah.
So the balanced advantage funds, the BAF category,
Absolutely.
as it's called. Okay, Devendra, come in on this. You also mentioned the equity savings fund category, right? Just remind us, remind our viewers, because not everybody invests in a lot of these funds. So tell us more about the equity savings category. How much is the typical debt equity mix, and whom are these funds suitable for?
Sure. So Surabhi, as you rightly said, the hybrid funds are categorized in terms of, how much equity you can have, and then other portions starts coming in. In equity saving as a category, you have 10 to 50% long equity, which is pure equity component, but you have a minimum of 15% in equity arbitrage. So in terms of taxation, it classifies as equity taxation because equity and equity arbitrage is always more than 65%, right? Then you can have, up to 35% in debt if you want to, which is normally a balancing factor. You also gives you steadiness in terms of that. But equity, pure equity, only up to 50%, minimum 10%. Arbitrage, minimum 15%, and then the rest comes in.
And
so this kind of
sorry, Devendra. So this is the equity savings fund category. Is this the same as aggressive hybrid funds? Because there's something called aggressive hybrid fund as well, right? Or is that something else, a different category which also has more than 65% or up to 65% equity?
So aggressive hybrid fund is a very different category. If you remember, this was earlier called balance funds. Before the balance advantage funds came in, this category was called balance funds, whereby in aggressive hybrid, you always have minimum 65% in equity, which is net equity, no arbitrage included, up to 80%.
Okay.
So 65 to 80% in pure equity, that is what aggressive funds are.
Okay. So fair enough.
Equity saving is different.
Yes, please continue. Please continue.
Equity saving is different, that the net equity portion is always capped at 50%. And the lowest you can go is 10%. But to have an efficient taxation structure, you have a minimum of 15% in arbitrage, equity arbitrage. So you get a minimum of 65% in equity and equity arbitrage, which is there for the investors to benefit from.
Okay. So Devendra, one final follow-up question. Now, suppose I am an aggressive investor. I already have equity mutual funds, but I also want to do a hybrid fund which has the benefit of equity taxation, and I'm okay to take risk. So between a balanced advantage fund, which is typically running more than 65% equity, this equity savings category, and the aggressive hybrid category, you described 2-3 different types of funds, right? They all have the same taxation now, equity taxation. How should I go about making my choice? What is the criteria that I should ask as an investor?
Okay. See, generally aggressive hybrids or the equity hybrids, they are ones for the riskier investor. Investors who have a high risk appetite, because they would anyways at all point in time would be minimum 65% long in net equity. Okay. Balanced advantage funds are generally dynamic funds which can go to as low as 20% or as high as 90-100% in equity. But typically they hover around 50-60% in net equity on a average basis, on a normalized basis. Equity saving is the least in terms of the risk appetite. So because they are capped at 50%, but typically, for example, at Kotak, we have an average equity of less than 35% over the span of this fund.
Okay.
So
Got
the
it.
more riskier the investor, aggressive hybrid, then BAF, and then equity saving.
Okay, superb. That really explains it very, very well. So if you're a high-risk investor and you're looking for a, higher risk profile fund, then that's the order that you can follow. Mohit, I want to take off from, what Devendra said on the balanced advantage category, which brings us to the next taxation bucket itself, right? Now we're talking about mutual funds, which will be holding equity to the extent of 35% of the total holding, going up to 65%, but not over 65%. So in this bucket, which is what Devendra is also saying, that the bulk of the balanced advantage funds typically run portfolios that they fall in this category. Now here, there's a huge tax advantage as well,
Absolutely.
right?
Absolutely. So, Surabhi, this was the bucket which was holding equity between 35 to 65% of the overall portfolio, which got hammered last year in the budget. So, when the taxation changed, this category typically got changed, and the taxation here was long-term with a 36-month holding period and tax at 20% with indexation, right? So it completely changed the entire mutual fund industry and divided the entire industry into three asset classes from a taxation perspective. Which is equity greater than 65, equity between 35 to 65, and then equity less than 35, right? So this middle category was the one which was having an indexation advantage with a 3-year holding period. Now this completely changes. This is now a 2-year holding period for long-term capital gains, and the taxation now has been reduced to 12.5.
Which is a double bonanza, right? You don't have to wait 3 years to qualify for long term. You just have to wait for 2 years, be invested for 2 years. And the tax is not slab rate. The tax is not 20%,
yes,
but it's 12.5%.
It's 12.5%. So taxation reduces, the holding period reduces. So obviously, as Devendra also said, the agility of the investor improves out here. He can move a little quickly, right? Plus, these are categories which were actually sort of more used by conservative investors. This was a category which was more preferred by retired investors, right? So for them, it becomes a little more tax efficient. From them, the actual realization of the money improves, right, in their hand. So I think overall, it just benefits the industry, and also the profile of investors who was typically investing in this category was a little more moderate, conservative, or retired, right? So I think that entire category benefits a lot.
Okay, so balanced advantage funds, now they have the tax advantage for sure.
Yes.
Let's also talk about the other merits, because like you're saying, tax should not be the only reason we invest into anything, right? Looking at the market environment, the dynamics, equities have been on a tear and everything's so volatile. Typically, would you advise people to opt for this type of a hybrid fund? And if yes, why so?
Look, Surabhi, as I said, it all totally depends on the risk profile of the investor, whether he wants to conservatively invest with modest amount of growth, but the objective is more or less preservation of capital to a large extent, then yes, you would want to go into these categories. A balance advantage gives you the advantage that fund manager with all the expertise and all the resources at his disposal is typically changing the equity debt mix in the overall portfolio and is trying to play out the market cycles, which has historically benefited the investors, right? Even in a multi-asset category, today most of the funds were being pushed to keep 65% and above equity. Now those funds can also become a little more true to label, keep slightly lesser equity composition, improve the commodities allocation in the portfolio, which was kind of hovering between 10 to 12% for most of the funds. So that could be improved. So it can become more realistic multi-asset from that perspective, right? So it all benefits the investors to a large extent.
So multi-asset, I'm going to come to it in just a bit and have a sort of more detailed chat on it. But balanced advantage itself is a category. Does it get a thumbs up from you?
It definitely gets a thumbs up, now more so because of taxation, but previously also because of the inherent advantages of movement between debt and equity and playing the asset allocation part automatically through a fund manager route was a huge advantage for conservative investors and few profiles of investors.
And would you like to take any examples or any names of the kind of funds in this category that you like, or what people should go out and sort of check upon?
So look, there are balanced hybrid funds also. There are balanced advantage funds also. Both of these kind of fitted into this category. There are some exceptions which ran over 65% equity allocation, but let's say Pru ICICI balanced advantage fund, Kotak balanced advantage fund, let's say, right? There was an HDFC balanced advantage, but which kept equity to a slightly higher extent at all points in time, right? And so you have, and then there is a balanced hybrid category. So you had perhaps a 361 balanced hybrid fund or those kind of funds which had 45 to 55% equity composition and 45 to 55% debt composition. They kept moving between these allocations. So those are categories which become extremely lucrative now from a tax perspective. They were always good as a profile fit for investors of certain categories or certain risk profiles, but now they become very attractive from a tax perspective also.
Fair enough. We need to take a break. But after the break, we are going to talk about this multi-asset category because I think a lot of investors have seen the kind of returns that gold can deliver to the portfolio over prolonged periods of time. Especially the last 1 year has been fantastic for gold. So whether we should consider the multi-asset category as well, now that it also has a tax advantage, we'll discuss this after the break.
Let's talk money.
Welcome back. You're watching the capital gains tax classroom when it comes to mutual fund investing because so much has changed after this budget. And of course, we have Mohit as well as Devendra Singhal to take our questions and help us understand this issue today. We were speaking about multi-asset funds just before we went into the break, and I want to bring in Devendra because he manages those funds at Kotak KMC. So Devendra, great going, right? Not only are asset classes like gold giving you such a great return, now the tax is also looking better. So what's your advice? And to the point that Mohit made before we went into the break, that now that the tax rate has come down, will we see these funds invest more in commodities like gold?
So, Surabhi, as you define multi-asset, multi means thus you need to have at least 3 assets with minimum 10% weight. Now, there's no, limitations in terms of how much one category can invest into the other. It all depends on how you have basically positioned your fund in terms of taxation. So you're right that with taxation angle going off, now you could have a more aggressive call in terms of higher allocation into particular assets like gold, international equities, and debt and all, and still get a benefit of lower taxation what was earlier. But this thing is now happening with more of fund of funds, which is the multi-asset allocator, which is the fund of fund category. In categories whereby you are investing directly into securities, I don't think there's any change in the categorization now. So that remains as it is, and it's lucrative.
Okay. Again, just asking you a basic question, if someone's looking to get into a multi-asset fund, what would be the realistic rate of return to expect? I know, we're not asking you to, promise something over here, but typically, depending on the asset class shifts.
See, typically when we look at, multi-assets or any hybrid schemes, we look at a ratio called upside-downside capture ratio. That is how much of when the market is going up, what percentage of the upside I'm able to capture, and when the market is going down, how much participation I'm having on the downside. Typically, over a long period, we have seen that this upside-downside ratio for most of the hybrid funds has been more than 2.5 therein. I think that is what we should look at rather than, looking at the absolute amount of returns. Because there are few funds in the category which have actually beaten the Nifty also over a long period of time. But having said that, if you have a lower amount of equity, then your returns should actually be lower than what the overall market returns are. Now, it is now depending on what you can do in terms of upping and lowering your equity allocations or other allocations which can give you that alpha, right? So I think that I'll leave it there without commenting as to what kind of returns one could expect. But definitely, if the endeavor is to mimic market returns, but since the equity component is lower than the market, one should have reasonable expectations around.
So let me just ask you as a fund manager, when you see a particular asset class doing so well, like gold right now, typically how do fund managers think? Is it time to book some profits and lower the holdings? Or, do you take a view as in the view right now that perhaps this is a long multi-year run. So therefore, and now that you're not bound by taxation, that you can actually go ahead and increase holdings in precious metals.
So, Surabhi, not everything is bought just for the returns perspective. You need to have risk also into your mind when you construct a portfolio. When we talk about multi-asset allocations, we are talking about 3 different asset classes coming in on a minimum side, and asset classes are supposed to have low correlation between themselves. So it is basically to give a smoother ride to the investors for a longer journey they have in the market, rather than just focusing on the return part of it.
Fair enough.
Having debt, having gold as an asset reduces the volatility which equities can provide. So it makes the journey a bit more smoother than what would have been normal side, just been equity. So I think that is what one will need to focus on, rather than just looking at the pure returns purpose.
Fair enough. All right. Let's quickly move to the next category, which also stands to benefit a lot because of the change in taxation. And this is the global funds category, international funds, which are investing in, whether it's US equities or maybe you even have some greater China funds and whatnot. Now here as well, this category was first taxed at our slab rate, but now it's going to be taxed at 12.5% if the holding period is 2 years or longer. So, Mohit, this sounds great. But, correct me if I'm wrong, a lot of funds were not taking any fresh money because of certain limits being hit already.
Yeah.
So, is it even possible to invest right now?
It is. Quite a number of funds are accepting fresh investments. Few are accepting only as SIPs and few are open for both lump sum purchases and SIPs. It depends on the contours of the fund. Funds which are purely ETF based, those are the ones where the limit has got busted and those are the ones which have stopped. But funds which are actively managing their allocations, perhaps directly investing into stocks or international stocks directly, those are the ones which are typically open. There is a whole list of funds, but I think category as a whole, Surabhi, has got a huge impetus. And needless to say, for an Indian investor, it's absolutely must to have a global diversification. Given the profile of our currency, which has been depreciating against the US dollar for almost last 20 years, if you see the track record, the depreciation has been on an annualized rate around 3 to 3.5%. If you want to counter that, if you want to have a real hedge against the country risk or the sovereign risk, or you just want to create a corpus offshore for your children's education or for anything, let's say, I think this is a great avenue available to retail investors, that you go out and invest in international funds. Again, this category got completely out of flavor last year when the taxation was changed, and now it's come back into reckoning with full power and full force. And I think all investors should definitely look at diversifying abroad.
Your favorite funds here?
Look, many. Honestly, I like the Edelweiss US Technology Fund. I like the DSP Global Innovation Fund. These are all active ones. But on the passive side, I like the NASDAQ fund of funds, which currently the open one is only Motilal. I think they're accepting SIPs out there. So if someone wants to buy NASDAQ directly, I think that's a good avenue to go for.
Okay. I mean, if you can put all the recent market volatility aside and look beyond and not get worried about the churn in global markets, right? Okay, we have time, I think, for just one question. Debt funds, there's no change to the best of my knowledge. There's nothing that sort of changes. It was slab rate earlier, it's slab rate right now. But we have a question from Abhishek. He's saying that he invested into a debt mutual fund in 2017. Okay. And this was his mother's name, who's a senior citizen. He's saying, what happens now if I redeem the fund, if I sell the fund now, is there any long-term capital gains tax advantage for me?
It is. Interestingly, this category, though, remains unchanged, but for people who invested prior to 1st April 2023, which is when the new debt taxation regime came in.
When the indexation was taken away and it was
taken away and it was put at slab rate. If you've invested prior to that and if you're selling after 23rd of July 2024 and if you have completed 2 years of holding, right, on your debt funds, then you will be taxed at 12.5% after 24 months for your previous holdings, right? So you still have a huge advantage, though you have lost the indexation benefit, but you still get taxed at 12.5 after 24 months. So it is, I think he can rejoice on that.
Okay, fantastic. We have just 10 seconds left. Devendra, any final advice to our viewers when they're approaching hybrid funds?
Hybrid funds gives you diversification. It gives you a risk-adjusted return. So keep that in mind because risk is always hidden.
Well said. Those are wise words to remember. Thank you so much, both of you, for joining in and helping us navigate through the new tax regime for these funds. I really look forward to more such conversations. Well, with that, it's a wrap on this edition of Let's Talk Money. We'll see you again, same time, same place next week with yet another theme on investing and your money.
Let's Talk Money